Want to know the latest on what's happening in the world of financial services? Tune in to Banking with Interest, a podcast from Intrify, a fintech that provides innovative products to help banks and financial firms of all sizes stay competitive. Hosted by Rob Blackwell, the former editor-in-chief of American Banker, Banking with Interest features current and former regulators, bank executives, journalists, and analysts discussing the financial services policy debates roiling Washington. Listen to Banking with Interest, available on all major podcasting platforms, or go to www.intrify.com to click on the link on our homepage.
Welcome to the American Banker podcast. I'm Penny Crosman. Banks have been ramping up their investment in generative AI, with large banks like JP Morgan Chase and Morgan Stanley making it available to all employees and hoping for large productivity gains thereby. But Sid Khosla, EY America's banking and capital markets leader, takes a sober view and predicts that within 2 years, 80% of the value of the technology will come from only 20% of the use cases. Welcome, Sid.
Thanks for having me, Penny.
Thanks for coming. So tell me about why you think the 80-20 rule applies or will apply in this instance. Like what were you kind of seeing in the field or elsewhere that brought you to that conclusion?
Sure. And look, like any technology, and I say this often, all technologies goes through what I call is their Darwinian journey. Right? You start off with looking at a lot of broad applications of that technology, and AI or generative AI or agentic isn't any different from that regard. But as you progress and you learn through both the use cases and data insights that's generating, it becomes very clear that there's a specific use for technologies and capabilities like AI and generative AI, especially as it relates to language understanding, content creation, complex data synthesis, and engaging with clients. But then there's always a complementary connectivity to other technologies, whether it's machine learning or rules-based systems that, at least in the short term, are better suited due to their precision, their interpretability, or their real-time decision-making capabilities. So I think we're all on this journey. Who knows if it's going to be 20%, 30%, or 40%? But the fact is, we're going to start with a broad funnel, and everybody's going to try that out. And as we progress over the next couple of years, we're going to find where most of the value, especially as it relates to generative AI, lies. What I also think is going to happen is, as this unravels, institutions will also realize that they need to be clear about where competitive advantage lies for each institution. And that's also going to drive where they want to think about AI as far as their use cases are concerned, and where they would lean into other parts of the ecosystem within the financial services space to tap into those broader firms. So, the 20-30% of the Pareto is more related to what, in that sense, is more related to what's going to be core competitive advantage for you versus what are the other areas you'd lean on, the ecosystem or third parties to do that.
Well, with what you're seeing so far, what do you see as some of the higher return use cases or maybe future use cases?
Sure. And I think the answer is different based on current and future. The start of all the initial use cases and experimentation has been more around operational efficiency, areas of customer service, which are giving lift. But longer term, I see those becoming much more commoditized versions of the leverage of AI or agentic. I think the longer term value, especially for financial services institutions, is going to lie much more around customer engagement and growth, as opposed to purely efficiency. I mean, efficiencies will always be part of the play. But I think that the hypersized growth is going to be around things like personalized offers. If you think about wealth management firms and the ability to give adaptive financial advice, think about like corporate banking. You have much more dynamic pricing, custom lending offers, And even in from a B2B standpoint, dynamic investment portfolios and things like that. I think that's going to be the real value drivers longer term, especially as it relates to growth.
Mm. So things that could bring in revenue potentially, or strengthen a customer relationship. It's interesting you say that, because I feel like I see a lot of emphasis on efficiency, on if we let people use a large language model to draft emails, they'll save X hours per week. Or if software developers use GitHub, they're saving X number of hours a week or a month. Do you think that's the wrong way to look at it?
I don't think that's the wrong way to look at it. Those are the use cases that may be important in the short term, right? But after a point, those use cases, like I said, would become a lot more commoditized. And the question is going to be, is that where the financial institution sees their own kind of competitive advantage? Which is why I keep going back to the point around this Darwinian journey. I think we're going to attack the places where current short-term value creation is, which I think makes a lot of sense. But longer term, where you'd want to lean in with technologies like AI, or the real impact of generative or even AGI when it comes to being, is where your institution's competitive advantage is. And that has to be around areas of growth, areas of engagement with clients, areas of connectivity of products and cross-sell, and much more personalized way of engaging your clients.
Yeah, I mean, certainly personalization has been like a holy grail for decades for banks. And it seems like that always comes down to having the right access to the right information that's up to date, and where you're really able to aggregate transaction and communications and so forth across many different applications, areas, lines of business, etc. Do you think we're finally, with generative AI, banks are finally going to be able to get to a point where they truly have useful personalization?
Well, I'm very excited about it. And between clarity around where the banks want to play, the kind of engagement they want to have with customers, and the ability and the capability that AI and agentic would offer. I think it's going to give us all the best shot of how to make this hyper personal, and we've seen that in industries outside financial services. So I think there's a lot to build upon there.
Do you think there are areas where generative AI is not a good idea, and that maybe a rules-based system or a more traditional machine learning system would be more appropriate?
So look, I don't think it's an either or here. I think this is the questions about how to use complementary capabilities and technologies for the best creation of value for the institution. Now, in the short term, I do think machine learning or neural networks or any other rule-based systems are better suited for tasks and use cases that need precision, that needs better interpretability or real-time decision making. And generative AI is particularly well suited for use cases that involve, like I said earlier, language understanding, content creation, scraping information, complex data analysis, and things like that. So, I mean, if you take an example of a classic institution, and there's going to be context awareness being brought in through AI. But you could think about regulatory compliance or reporting, or even transaction monitoring, eligibility checking, onboarding of clients. There's a significant amount of legal and regulatory requirements that need to be interpreted as a very rule-based system in that way. And then it also needs a significant amount of rule-based logic to kind of make predictable decisions around anti-money laundering, for example. So I do see there, more rules-based system being a significant advantage, in addition to the context awareness that an AI would bring in.
So when it comes, a lot of banks, I think, have hopes for using generative AI in their customer chatbots to, generate really useful answers to questions, and then eventually add agentic AI so that, somebody asks for some kind of transaction to happen, the agentic AI can just take care of it and a human wouldn't have to be involved. But I think there's still some hesitation to put a generative AI based chatbot in front of consumers because of the chance of an error or hallucination or misinformation or outdated information that could be put out there to customers. Do you think banks are right to be cautious in this particular use case?
Yeah, no, I think it's a great question, Penny. I think the banks are, and all institutions are right to be cautious around that, right? Because again, these are early days on the maturity of the technology, and there's a few things going on there. One you've mentioned, which is all around risk and liability, and could be around inaccurate information and advice, and that could lead, especially in this business or in this sector, could lead to serious financial consequences for both clients and as well as for the financial institution from a legal liability standpoint. I do think there's still work to do on data security and privacy, especially as we largely deal with large language model industrialized across sectors, and not necessarily small language models that are very specific to the institution itself. So I think those concerns remain. A big inhibitor in acceptance is also around customer trust. You and I have all been in situations where we prefer having a human interaction versus a chatbot, let alone being a AI-driven chatbot. So I think that's a journey we're all going to be on. There is this perception of lack of empathy and emotional intelligence that customers may feel related to chatbots, and that's creating some inhibitors. Though I don't think longer term that's going to be an issue. And then the last thing I'd say is, especially from a regulatory uncertainty and compliance standpoint, there aren't very clear regulations around how to leverage AI in banking, especially as it relates to the regulatory framework, as well as how interactions with clients need to happen. So I think that explainability and transparency is going to be important, especially as we progress the maturity of the regulation around it. So I'd say those are the 2 or 3 things that are clear inhibitors here. Though again, I think it's going to be a journey, and we're going to see some significant increase in both the deployment and acceptance of AI in customer interactions.
So you have mentioned in the past that banks' ability to use their proprietary data will give them a competitive advantage. I think particularly using proprietary data in their generative AI models. What are some examples of this? Does this go back to the personalization you were talking about a little earlier?
Yeah, sure. No, I think personalization is a good example of this. But see, the heart of this is the use cases are important, but what the use cases really derive is insights based on the underlying data, right? So I think what is presented for institutions, which could be a really strategic advantage, is the ability to use something like AI or generative AI to bring together proprietary information that the banks may have, and then publicly available information to create much better decision making for them. And this could manifest in different areas, Penny. Risk management is an important area, and especially if you combine publicly available information, proprietary information you have about customers, plus, like we were talking about, the good rule-based engine. Fraud detection can get really, really precise, especially as you analyze transaction patterns and customer behavior and prevent fraudulent activities there. I think credit risk assessments are a really good example where both proprietary information and the aggregate data that institutions may have about behavior could marry really well with the ability of AI and combined with rules-based engines to get better insight. You talked about personalized offers and product recommendations. We're seeing some really exciting stuff around custom lending offers or even optimized loan structures as institutions engage with clients, leveraging a much more analytical approach and very proprietary data around these kind of products. And then you can't really talk about proprietary data if you don't talk about operational efficiency that could create as well. The 2 or 3 examples I've seen significantly being talked about in the last want to say few months are optimized loan origination is a great use case. Where loan application process and key processing times have been reduced just based on leveraging data analytics that have you focused on where most of the risk is versus not.
Well, you talked about using this technology to make better decisions, and I was thinking that that's a hard thing to translate into a return on investment. Do you think that how can banks look at that kind of thing where they're using generative AI in the background and maybe their decisions are more better, more precise, better weighted, but they're not necessarily generating revenue or getting any sort of direct cost savings out of that? How do they make the case for that kind of use?
Yeah, I mean, like this adage has existed for a very long time, and everybody overestimates the value of a technology in the short term, and then severely underestimates the impact it may have longer term. And I think that's what's going on. Look, in the short term, just because there's so much experimentation going on, the cost of processing and server capacity and energy is so high. It may seem as these efforts aren't getting the outcome they want, but it's also a question of you do want to learn through this experimentation and learning through the use cases that make most sense for you. So there's a couple of things that are going to happen. Number one, I think value being delivered through, especially some of the use cases we talked about, I think it's going to exceedingly become very accretive. And then the cost of developing just the AI infrastructure as well as small language models that are very specific to institutions and use cases, I think it's going to continue to go down. And through that combination, we've already seen some of that in the last few months. Longer term, there's significant value to be derived out of this. This is not a passing fad. This is pretty structural to the way we do business, and you're seeing both institutions and capital markets and valuation of firms changing differently based on that.
So going back to your prediction that within the next 2 years, generative AI uses will follow the 80-20 rule, where 20% of the use cases provide 80% of the value. Can banks beat that and get that ratio much more favorable in the sense that more use cases provide more value? And what might be some best practices toward that end?
Sure. And look, like I said, the 80% of the value may come through 20% of the use cases through AI. But there's still going to be a lot of leverage and complementary leverage of other technologies, like we talked about. So I just wanted to make sure I frame that way. Look, there's two or three things that are important here. Number one, knowing, and this is a big transformational time, is always a good time to reinforce on what your competitive advantage in the market is as an institution. Technologies enable that advantage. They don't necessarily only create the advantage or add clarity to that. So I'd say number one is the firms we're seeing be very successful at this are very clear about what their competitive advantage is in the market, and then back that advantage and point the technology in pursuit of that. So that's number one. Number two, I'd say is we're increasingly seeing a very business and a business user driven approach to especially agentic AI. The democratization of creation of agents, kind of putting the technology in the hands of business users. It has a couple of benefits there. Number one is these are the folks that are closest to the day-to-day operation. So the translation of what needs to happen into a technology or into an agent is actually pretty quick. And then second, from an organization change and acceptance and buy-in standpoint, it's definitely a shorter path there. So there's something to be said about the democratization of the technology and putting it in the hands of business users, so they can create value as best defined that, and then leverage what's being created, whether that's agents or even a multi-agentic scenario, to bring back in an overall governance and reuse framework that helps the rest of the firm. And then the last thing I'd say is, I think rapid learning is key. And in this Darwinian journey over the next few months and years, it'll be clear where you want to double down in terms of use cases and where you want to fail fast. And a part of the learning here is going to be to fail fast really quickly in use cases that just aren't the right ones for AI. And firms that are able to make those decisions quickly are going to be seeing the success, as opposed to firms that may linger on too long in a set of use cases that may not be where the best use is.
All right, that makes sense. Well, Sid Khosla, thank you so much for joining us today. And to all of you, thank you for listening to the American Banker podcast. I produced this episode with audio production by Wen Weist, Jean-Marie. Special thanks this week to Sid Khosla at EY. Rate us, review us, and subscribe to our content at www